And really our view on China from a strategic long-term perspective is that A, gives you more exposure to the signature policies of policymakers, which includes this significant transformation in the economy from debt-fueled infrastructure and property to the so-called new productive forces and the leading industries of the 21st century, as the Xi Jinping administration is wont to call these. So if you look at the sectoral distribution of A shares, they give you more exposure to that. And so we figure that if policy is more supportive of directing capital to those industries, that's from a long-term perspective where you want to be focused. And then on top of that, you've got a very clear need, which was evidenced in the 9 measures which came out in April, to develop the domestic market for a host of reasons. I won't go into all of them, but including the need to have a capital market base in order to source and support the development of new technology industries. I mean, in other words, you can't have the banks do the work of private equity and venture capital when you're trying to develop new stage tech companies. So things like the little giants and so forth in the A shares are ones that need that ecosystem. And then on top of that, you need to develop your pension system, which means you need a domestic set of capital markets, both debt and equity. So there's a host of reasons why we think that makes sense longer term. That being said, tactically, we have a model that kind of toggles us between A and H, and that's been signaling being in favor of H, which so far has been appropriate. And I think the one key point, my last one here, is that if you look at the second quarter results, we did a big study of 6,000 Chinese companies, and A shares had 0 earnings growth in the second quarter, whereas the H shares had 12%. Why? Because the domestic economy is weak. You have an imbalanced Chinese economy. Exports doing better. Domestic economy is not doing well. You've got more domestic exposure, as I just said, with the A shares, so earnings under pressure. H shares, really led by the offshore platform companies, had strong numbers and above expectations. So I think the near-term win is behind the back of the H shares, but longer-term strategically, we think there's an argument for A. But of course, really what our core message here is you need to be selective within the market. We're very well aware of and have written extensively about the longer-term structural challenges China faces. But underneath the surface of this, it's a very large equity market, still the second largest in the world if you combine it all. You've got, round number 6,000 companies to choose from. Lots of alpha opportunity underneath the surface.